In this video, I'm going to talk about financial scams to avoid, the Martingale Position Sizing Scam. Stay tuned. Hey traders, a very warm welcome to you. Okay, so Martingale Position Sizing. Let me just outline briefly what it is, and let me put some caveats in there, and then let's talk about the scam and what we've got to be careful of. So Martingale is basically the price is going against you like this. You're adding to your position, you're doubling your position size every time, or you're doubling the trade size on the next trade. So here you're doing, let's say 1, here you're doing 2, here you're doing 4, here you're doing £8 per point contracts, whatever it may be. The point is, you only need a little bit to come back in your direction to basically make a small profit. That's the idea. And the same with losing trades. You know, if you're losing, your stake here goes up, doubles each time. So 1 to 2, 2 to 4, 4 to 8, 8 to 16, etc. Maybe you get the winner, you win back all you've lost and you get a small profit. So in theory, if you can martingale up infinitely, you will always make money, right? That's really the idea of martingale. I've done a video before about martingale and how it could potentially play a place in your trading, or have a place in your trading under the right conditions, in the right scenarios. A bit controversial, but it was there and I kind of talked about that. But what I'm talking about here specifically is in social trading. Okay, and these are the kind of things, or even not necessarily social trading, it could be, is prevalent in there. It could also be in a system that you're buying or something like that. The point is, it's something that you look at it, visually and you think, hey, that's great. But under the bonnet, under the hood, you know, you're kind of thinking, actually, there's a real risk of ruin here. And this is the thing with martingale. Yes, it works and works, but how quickly it can get out of hand. You know, this number can become extremely large very, very quickly. And if you're trading a demo, it doesn't matter. You know, if that's 1.6 million, it doesn't matter. You're a demo. If you're real money, you started out, you know, a few pound a point, and now you're up to $1 million. Obviously, it's not feasible. So the risk of ruin with this is there, and it will always happen eventually, because you can't increase your size infinitely. You can't constantly be doubling up on your position hoping that it comes around. But this is kind of what a typical equity curve of martingale will look like. Now, if it's you know, if it's talking about number of trades and then martingaling into the trade, this is sort of thing it will look like. You'll kind of have winning trade. And actually, there won't even be any drawdowns. It will just be perfectly smooth. But I've just done this just for kind of illustration purposes. But you will have situations like this. And if someone's doing true martingale, the only time they will end up losing is if they have no margin or whatever it may be. And obviously if they're a demo account, that's going to be huge, but there'll still be a point where they can't do it anymore for whatever reason. And eventually it'll just go to zero. That's exactly what it will look like. Okay, you may have situations where you get a few drawdowns in between where they've cut it off a little bit earlier than the most drastic point where it starts not working, where they're trying to trade mean reversion, it's not working, get these kind of drawdowns. But ultimately, you're going to lose all your money. So if you're thinking of following somebody on social trading, by the way, very useful tool. Some people love it, some people hate it. I think it's got some sort of use there. You know, you can follow people and just see how they're trading and what's going on. If you're a beginner, it's not a bad place to start. It's got some sort of value and some sort of utility for a trader. So check out stuff you know, related to that. But also, you know, if you're buying a system or a strategy, just say, hey, what's the position sizing? Because yeah, one part of the system or strategy are the rules of the system and when to go long, when to go short. But how is the position sizing? If the position sizing is well off, the system is completely useless. Especially if you're doubling up after every losing trade. Yes, your equity curve. If you're doing that, by the way, then you might have a situation where let me find my marker. Wipe. That'll do. You might have a situation where, you know, you have a winner. Yes, you might have a loser, but the next winner, because of the size of it, will take you straight back to there. And so you'll still see, and if it's smoothed out and someone's maybe being a little bit sneaky with the way they're telling you how it's been traded, smoothed out, it might look like that. But actually, there might have been, you know, a little bit of a drawdown as it's losing trade, winning trade takes them right back up to where they were. So just being cautious generally I've put Martingale here, but generally about position sizing approach of anyone you're considering following on social. Like I say, a useful tool does play a part, and I think there's definitely some value in social trading, but just being careful that someone isn't kind of overdoing this position sizing abuse, especially that you can do with a demo account that you would never be able to do with a real account. Cautious of that one, and cautious about adding to the size, and cautious about how they position size after a loser to massage the figures to make things look good. So that's the Martingale position sizing scam, guys, or warning to be careful of. Let me know your thoughts in the comment section below on that one, and I'll see you in the next video. Take care. Bye bye.